This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Well, welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, October, oh my golly, August 8th. We're talking about zombies and I'm thinking about October. It's only August 8th. I'm here to help you build a strong financial blueprint 1 week and one show at a time. We'll get to the October show in a couple months. If you're hearing my show at a different time or day, you're listening to a rebroadcast, you can call into the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com to discuss anything regarding money with myself or any of the guests that I have into studio. Right now, we're going to be talking with Gary Cassill with Mountaintop Advisors on investing in low interest rate world. We're going to talk a little bit about how to invest in commercial real estate, how to participate in that. So great to have you back in studio, Gary. Thanks for coming in.
Hey, thanks a lot, Tina.
And a little background about Gary. First licensed in 1984, Gary's been in a high volume bank program and at very well-known credit union. He has a Series 6, 63 and Series 7 license in addition to being fully licensed for life insurance and annuities, both fixed and variable. So Gary, we're going to talk a little bit about a lot of different things today, but right now I want to talk about the historical low interest rates and how is this affecting things with investors, what they should be doing right now with the rates so low.
Well, I think the main thing that you should be doing is kind of planning ahead. The Fed's talking about, Janet Yellen's just talking about possibly raising interest rates.
Yes.
They're at super low historic rates, and something's going to happen at some time. I don't know when. I know.
We've been saying that for the last few years. It's at some point in time in the near future, we have to see interest rates go up. So
exactly.
Yes.
So when that happens, it may or may not affect bonds or stocks, but it will affect bonds. Bonds are directly affected by interest rates. So what happens there is a typical investor could have as much as 40% of their portfolio in bonds.
Yep.
And it's like looking at a teeter-totter where you've got interest rates on one side and then you've got the value of your bonds on the other side. And if one side goes down, the other side goes up.
Yes.
And so that's what they need to be aware of is that we've had interest rates going down and down and down, which has been pushing up bonds this last 30 years.
Yes.
Yay. That's a good thing. But the opposite's going to happen when it goes the other way, and that's what people, I think, are kind of lulled into sleep and not maybe thinking about as much. And
so do you see your typical investor, a lot that are investing in the bond market right now?
Yes. It's not unusual to have a 60-40 portfolio, 60% stocks and 60% bonds, and they could be mixed up with all sorts of different bonds and all sorts of different stocks, but that ratio is kind of the golden ratio that's been recommended for a long, long period of time. Yeah. So do bonds make you nervous? The stocks, what are... Bonds are inherently very safe, and they produce a nice, consistent income. People like that. Because interest rates are low, they don't produce a lot of income. But when interest rates start to go up and you're holding onto a bond and you can now get a new bond with a higher interest rate, how are you going to sell your other bond? Yes. You're going to sell it at a discount. That's the only way you can get rid of it. Yep. And that's what people are going to be kind of shocked by. So on the stock market, since it's at an all-time high, where are the buy low opportunities? Well, to my way of thinking, the buy low opportunities, anytime you're looking at investments, you want to look at something that's got a very solid supply-or-demand driver. So when I look at the economy, one of the worst hit parts of the economy was construction. So during 2008, when the downturn happened, commercial building greatly slowed down. What that does is that leaves growing markets like, healthcare, senior housing, and maybe apartment buildings kind of way behind in their natural replacement. You need to replace those buildings. They get old, they wear out, and they're no longer Class A. They go to slip into Class B, or they go from Class B to Class C. Sure. So you just need to replace those, and you need to increase the amount of those in growing industries like those. So being a landlord, if there's a constrained supply, then you get to charge more rent.
Yes.
So then that's a pretty enviable position to be in.
Yes. So what about, Gary, with commercial real estate opportunities? Because a lot of people probably don't understand that there are opportunities. You don't have to have millions of dollars to get in to the opportunity to purchase or have a part of commercial real estate. Can you talk about that? Well,
sure. So before I talk about that, one of the things that happens is when we had a downturn in the amount of construction, a large part of that was due to the fact that banks weren't loaning.
Yes.
They already had a bunch of bad loans on their books. How they got there is history, but they had them, and they didn't want to go out and get a whole bunch of new loans for real estate. They already had plenty of real estate loans. They wanted to go loan on something else. So if you have a building for sale, a commercial building for sale, and somebody walks in and says, I'm a cash buyer, I don't need financing, you perk up, your ears perk up, and that's the person that can negotiate a pretty good deal.
Okay.
So, but you can get into, getting back to your question, the average investor, you don't need to have $20 million to go buy a commercial building. You can buy into a thing called a real estate investment trust. And it's a type of securities. And the minimums on those, a person could get in. Some of them have a $50,000 minimum investment. Some of them have a $10,000. Some of them even have as low as $2,000 if it's in an IRA type of account. So that's pretty easy to do.
So how does a real estate investment trust compare with the stock market? And is there an index to compare and see, kind of like the S&P 500 index?
Exactly. Yes, there is an index for real estate investment trusts. And if you go back, it's been around for quite a while. If you go back, Oppenheimer Mutual Funds, as an example, they did a study. They wanted to know, hey, how good are these things?
Okay.
So back in 2013, they came out with their results of their study, and they said that if you took the average real estate investment trust and you compared it to the average of the stock market, which would be the S&P 500, and you mixed them all together, the real estate investment trusts as a group, the good, the bad, and the ugly, all of them together, if you looked at it under a 3-year time frame, 5-year, 10-year, 15-year, 20-year, they outperformed the S&P 500. If you went even a little farther than that, 25 years and even 30 years.
So, Gary, if they're performing so well, why aren't there more investors that are investing in the REITs instead of the stock market?
I'm not sure. Yes. Nobody came to me from the big brokerage houses and said, Gary, we're not doing it because of this. We're nervous about this, or we just don't feel that people should know about these things. I suspect that it's a lot of it's fear. I know that the ones that are selling real estate investment and trust, when you go to a broker that's familiar with alternative types of investments and they're selling these things, very often they'll have restrictions on the percentage of a portfolio they can put into them. They might they're also going to have some extra disclosure forms because they're worried that they're going to get sued, that maybe you didn't explain everything or the customer didn't remember everything you told them, and later on there could be a legal issue. So I think a lot of it's that. They're a little bit newer investments, and they'd rather let somebody else experiment first before they start promoting them, I'm guessing.
So who are you seeing that are investing in the real estate trust?
Well, real estate in general for commercial, where I see it's mostly people that are looking for income.
Okay.
So you buy into commercial property, and the idea is that you want income. So you buy the building and you're collecting rents. So the income seekers are looking for them, and it's also a good hedge for inflation. Later on, the building should be worth more.
Okay.
But the biggest adopters of real estate have been these large endowment funds. So Yale, Harvard, Stanford, they've got these large endowment funds. And it's the money that they operate, the earnings off of that is what allows them to operate as an entity and to offer scholarships to bright new students, which may end up later on giving them more money into the endowment. The people that are running these are pretty smart, and the people that are donating are pretty smart, and so they generally expect a pretty decent rate of return and some consistent results. So to use as an example, Yale News reported that their endowment had $23.9 billion in it. That's a lot of money.
Yep.
That's a lot of responsibility to not mess it up. And since 1985, What they have done is they reduced the amount of U.S. stocks by 92%. They reduced the amount of bonds and cash by 75%, and they increased their real estate holdings by 120%.
Wow. That seems crazy.
It's working.
Huh.
It's working really well.
Yeah.
Last year, they reported that they, over the last 10 years, had earned an 11% rate of return, and the average stock investor got 6.8. So 11% versus 6.8, that's...
So if any of my listeners, Gary, want to get more information on real estate trust, where can they get that information at? Real estate investment trust.
They can talk to their investment advisor. They can call me, but yes, they could call their investment advisor, and that's where they would get information about those.
Okay. Any other tips that you have, or what would be the concerns or things that somebody should watch out for in looking at investing in real estate investment trust?
Well, the biggest thing to be aware of is that a lot of these are illiquid investments. What that means is if you've got a mutual fund, if you've got a stock, even if it's down, you can sell it tomorrow and you get your cash out. A lot of these real estate investment trusts are not liquid. They generally pay a higher rate of return than some other things, but that's because of the illiquidity. You give up something on that end to get that higher return.
Makes total sense.
Yes.
So not something that you can just turn around, and kind of like your real estate property as well. It's a little bit different than just cashing in your stock. Any other advice that you have that is unique on investing in the real estate investment trust versus in the stock market?
Be very selective.
Okay.
There are some that look really wonderful, but you need to look under the hood and be very, very careful and have somebody who knows what they're doing kind of analyze them and look at them. And Titan Securities, where I do all of my business, they're very, very good at checking those things out. And I'm sure some of the other brokers are also very, very selective before they'll allow something to go out in front of the public and possibly tarnish their name. So.
Got it. So whatever other advice are you giving your clients right now, Gary? I mean, in this environment and the opportunities out there, what advice are you sharing and helping your clients with?
I think the main thing is that I don't know when interest rates are going to go up.
Yep.
But if I'm a little bit early in giving somebody the advice to, hey, maybe it would be a good time to slip out of the bonds and move into something else that kind of acts like that'll give you income consistently but doesn't have that interest rate risk, maybe jumping a little bit early wouldn't be the worst thing in the world.
Got it. And really just understanding, again, what your options are, what is available out on the market. Who knows what's going to happen with interest rates? Again, that's my arena in doing mortgages. But if you can anticipate what you think employment's going to do, it's probably a pretty good indicator of what interest rates are going to do, because they typically follow employment. And just as Gary was talking about, a lot of people don't understand how the interest rates work. They are directly tied to the bond. Fannie Mae 30-year bond is for mortgage interest rate. So what you typically see is if the economy is doing really well and we've got great economic news, then investors are going to be investing in the stock market because of the higher return. When there's some negative economic news that's happening, that's where investors get worried in the stock market, and they're going to pull out and go into the bond market. So mortgage rates being directly tied to the bond market, as the bond market's trading at a higher price, that's good for interest rates. When the bond market drops and trading at a lower price, not so good for interest rates. So, Gary, it's a pleasure to have you in studio and back again. I appreciate it, and it's always nice to have a little twist on investment and talk about something that a lot of people are not aware or that are out there. So thank you so much for sharing that with my listeners.
Sure, you bet. It's Alternative Talk Radio. Might as well talk about alternatives.
There you go. This is your host and mortgage expert, Tina Mitchell, signing off for the day. Enjoy the rest of your weekend. And please remember, if there's any topic that you would like me to bring into studio, anything regarding money, that's what the show is about and why it's called the Money Hour. Every Saturday, right here on 1150 AM at KKNW. Enjoy the rest of your weekend.